Tata Motors has been a big loser today because UBS has retained the sell rating on the company with the target price of 825. More importantly, BMW has come in and cut their targets on global slowdown factors, which will obviously impact all global car companies, JLR included. Puneet, my colleague Johnson, with some highlights of the note on Tata Motors, and then maybe a brief update on what BMW has said too. Puneet, good morning.
Hi Niraj, good morning. So definitely, negative for Tata Motors, and, stock is reacting on this UBS note. Now, this note specifically talks about, the JLR division of the company and how the higher discounts that they're offering now will be a key negative going forward as well. They have mentioned that, the Range Rover Sport has seen a very sharp and a surprise rise in discounts in the month of July globally as well that they've announced. It mentioned that, the company has launched these 3 models, the Defender as well as the 2 Range Rovers back in 2020, and over the last 3 to 4 years, they've seen successful rollouts of the same. But now that momentum seems to have slowed down, and new launches will only be happening in the next year when JLR comes up with the electric vehicles going forward as well. Now they're transitioning away from petrol and diesel completely. So that's one of the key things also to watch out for, that they will have to support growth only through pricing mechanisms going forward. Now order book is another key metric tracked here. It's at a record low pre-COVID. It's touched the low which it had seen last in 2019 itself. So that's another key thing to watch out for, that the growth momentum hasn't come forward. They have mentioned that average selling prices of their cars also has gone up by roughly 49% compared to 4 years ago, and now they will have to start moderating them going forward as well because of the affordability factor, as well as customer having a larger choice as well with competitors. Finally, they have mentioned that they wouldn't be surprised to see some discounts on the Range Rover as well as it's currently a near zero levels of discount on one particular model, the top one, and they are saying that they might be seeing on that. Finally, valuations, they see JLR at roughly 7 times price to earnings, and are seeing 10 to 14 times EV by EBITDA for the CV as well as the passenger vehicle division. Both of them are slightly in the struggling zone right now, and recovery is only penciled in the second half. So overall, slightly negative picture on India business, and JLR, they have mentioned that it's not a good time for the company itself. Back to you.
Okay. Well, Puneet, thanks for that. Puneet, quick 30 seconds. BMW sounded on the bugle of caution as well.
Yeah, definitely. It's a
30 seconds. Yeah,
it's a very big negative news coming in from BMW in Europe specifically. It just highlights and quantifies what they are going through. They have mentioned that they've cut their EBIT margin guidance to 6% from roughly 10% last year. Free cash flow is another thing. It will be roughly at 4 billion euros for the automotive division versus 6.9 billion that they reported in the same time last year. And some Indian suppliers that we looked at, Motherson would be one of the key ones that would be affected because they have roughly 4,900 odd crores of revenue coming from BMW. That's roughly 5% only for them, but still a big impact compared to others. The other 2-3 companies would be Uno Minda, Minda Corp, as well as Endurance, because they are very big companies having exposure to Europe. They also have joint ventures there. So watch out for these stocks in trade today on the back of this news from BMW. Back to you.
Thanks for that, Puneet. Well, let's get in Rajesh Kothari, MD of AlfAccurate Advisors, on the conversation as well. Rajesh, great having you. Thanks for taking the time out. And, I'm going to take a leaf out of what's the recency bias in the markets to start off the conversation. On the global front, BMW and some of the other automakers sounding off the caution bells. People are talking about the same when it comes to four-wheeler inventory in India and what are the kind of discounts on offer during the festive season, something that we probably haven't seen since 2019. Are you sensing, Rajesh, that urban discretionary consumption or urban consumption at large is slowing down? Is that indicative of what could happen to the economy?
Hi, Niraj. I think, Niraj, there are pockets of consumption which are doing extremely well. And there are pockets of consumption which are, I would say, a little bit moderating. And there are, of course, pockets of consumption which are still not yet improving. They are still in the slow lane. I think what is happening is that the Indian consumer, the entire wallet, the spend of that wallet is changing. Right? It is not a macro thing that consumption is slowing down. I think that will be a wrong judgment. For example, if you look at the entire car industry, the premium end of the car is doing extremely well. Right? The problem is that I would say below 10 lakhs or even a little bit on the mid side, but the premium car segment is doing extremely well. If you look at the real estate registrations, they are doing extremely well. And within that, if you look at the premium real estate, it is doing extraordinarily well. Correct? So I think there are basically patterns which is happening. The wallet of the consumer is changing, and a company which are rightly positioned to those wallet, they are basically becoming a gainers because there the profit pool is expanding disproportionately. So I think it's less to do with the judgment in terms of the overall economy, but I think there are pockets which are yet to improve, and there are pockets which are strengthening.
Okay, and right now we're talking just about urban, right? Rajesh, you believe that I'm not even focusing on rural, or maybe you take an overall consumption, because the common belief, Rajesh, seems to be, or the sense that I'm getting when I'm doing these conversations, is that rural is making a comeback and urban is slowing down. You are saying that that's not necessarily accurate across the board.
Sure, you are right. It is not necessarily accurate because urban, as I'm saying, every pockets, whether it is a rural, whether it is a urban, there are pockets which are doing well. There are pockets which are not doing well. Correct? And that keeps changing, right? The wallet share is changing. And that's what is very important to understand. Because ultimately, Niraj, please understand, we all need to finally decide which are the companies which are rightly positioned for those profit pool. If you have that kind of a companies, while constructing portfolio, you will do well. If you're on the other side, definitely you will not do well. So macro, broad indicator, I think, there is nothing like that consumption is slowing. Because then what is rural, what is urban, what is semi-rural, what is semi-urban, all are very, what are very, very loose terms. I don't think there are any indices by the government which says that urban consumption versus rural consumption, right?
Got it. Okay, fair point. And in fact, well, viewers, companies have also made this point to an extent. While there are broad buckets, but it's very difficult to kind of alienate one versus the other. So in some cases, companies have mentioned that too. So point well taken. Okay, Rajesh, let's talk about profit pools then. Assuming that it's difficult to predict what the markets will do over the course of the next 6 months, because we've been calling and crying wolf about the valuations for a while, but the market has a mind of its own. So let's leave that question out. I want to talk about this argument that you make very correctly about profit pools. And so identify for us, according to you, where are the 2 or 3 or 4 largest pools of profit available over the course of the next 5 years, and which businesses are probably primed to take advantage of those profit pools?
So one is, of course, the energy transition, the green side of energy. That is one of the largest, I would say, incrementally growth perspective is one important segment. Second important segment is a data center related capex. And when you put up one data center, roughly 40% of that cost goes for the electrification. So it means all types of electricians which gets involved, be it a transformer and so on and so forth. The third important segment is, the HVDC part of the power transmission. One is normal power transmission, like normal consumption, there is a normal power transmission. But then there is a HVDC related transmission, very, very incrementally, significantly high growth going to be into that part of the segment. When it comes to the, say automobile and auto ancillaries, the content per vehicle, the disproportionate increase there, be it airbags, be it sensors, be it automation, be it alloy wheels, and premiumization of that content. When it talks about the consumption side, a company which is can meet the aspirational at an affordable price. There is a huge demand, but at a right price point. And there are only 1 or 2 or 3 companies which can meet those aspirations at that price point. And these companies are growing 25, 30, 40%. They are not complaining about any slowdown, be it rural, be it urban, be it semi-metros, correct? When it comes to the pharma side, the CDMO side of it, the huge profit pool opportunity over next 3 to 5 years. So there are companies which are rightly positioned, to capitalize on the U-turn on the US companies incrementally spending more on R&D. If you talk about, for example, the building materials, the wires and cable side, over next 2, 3, 4 years, you will see more growth on wire and cable side. If you talk about real estate, there are pockets where premium segment, not affordable side of it, mid to premium segment is growing disproportionately. That's another profit pool opportunity. If you talk about banking, the housing finance is a one bigger growth opportunity compared to the normal banking trends. For each sector, Niraj, what I'm trying to say is that for each segment, for each sector, you need to do segmentization. And then within each segment, which are the right companies positioned to capitalize on that growth, and position your portfolio accordingly will make significant amount of wealth over the next 3 to 5 years.
Point. I'm going to take your real estate point as the last question of this conversation, but before that, the second last point of this conversation, Rajesh, is on something that has become a big talking point, which is the correction in crude prices. Now, a lot of views around how the near-term profitability of the oil marketing companies, for example, will look very solid as a result of this fall, particularly companies which have a lower refining and a higher marketing piece within that. There are 3 names out there, so I'm not going to ask you about stock ideas out there, but just trying to understand, are you constructive oil marketing companies because of this crude price fall, which looks slightly more structural, or would you avoid them? Why or why not?
Well, Niraj, as you are aware, we strongly believe that we should focus only constructing portfolios on the companies where we have some, competence to ability to predict the earnings power, correct? So we do not buy oil marketing companies. Generally speaking, we avoid this entire basket because we believe we cannot predict the crude oil. And it's just not about the crude oil. It is also about the tariffs. It is just not about the tariffs. It is also about the government policy of petrol, diesel prices. Now, all these things are beyond anyone's ability to predict, and therefore, we continue to avoid by and large this space. There are enough opportunities available in the market. While people keep talking about valuations going all-time high and all that stuff, but there are enough opportunities in the market, even at the current valuations, where there are companies which are growing 18, 20, 25%. Think of it. India's largest company, correct? I mean, Reliance Industries in AGM. Please put a disclaimer. We do want it. In the AGM talking about the doubling EBITDA in 4 to 5 years. Now, this is one of the largest private sector company in India. Is talking about doubling EBITDA. I'm not talking about mid cap. I'm not talking about small cap. I'm not talking about micro cap. So you can imagine the kind of growth opportunity available for many companies is pretty large. Is probably significantly larger than what probably right now market is expecting in their consensus estimate. Correct? And that's why probably the market is not falling to that extent, because market is looking at that future earnings power. And those are all new growth drivers. Those are no more traditional growth drivers. And they are growing disproportionately. Those new growth drivers, they are not growing 10, 12% compounded. They are growing 20 to 30% compounded. So if for any company, if that new growth driver is going to become 25, 30, 40, 50% of their business over the next 4 or 5 years, then your overall growth gets higher from 12% to 18%. Correct?
Got it.
And then
Got it.
Look at Nifty valuations. They are still at almost equal to 10 years average valuations.
Okay. Well, a constructive note out there, Rajesh. 1 minute because we have a management waiting, but I saved that for the last simply because I heard you mention about companies which are in the mid end of the housing segment, right? Something like that you mentioned, not the premium housing, but the other side. So the company next probably specializes that's Brigade Enterprises. I'm trying to ask you, if you had a question to ask to a company which is engaged in that business, what would that question be? What is it that you would want to know from a company which is doing that, which has increased the base over the last 3 years? What is that one thing that you would want to know from such a management?
For any real estate company, question always is only one question. What is the current inventory and inventory to sales ratio over next 2 to 3 years at the industry level? I'm talking about a particular region. Say, for example, you're talking about, say, Brigade, then we should ask the segment in which they are into. Say, for example, Bangalore, how is the inventory of the industry is moving? And what is the pipeline? The pipeline to inventory to consumption, that's basically drives the, your pre-sales. And the pre-sales moves to your EBITDA over a period of 2 to 3 years. And that's what basically moves your stock price.
Okay, well, from a stock price perspective, that is the most pertinent question that we will ask Pavitra Shankar and some more. But Rajesh, so good talking to you. Lovely talk about the profit pools yet again. We should try and engage into this conversation at a slightly longer level some other time. But thank you so much for joining us today.